Hello, folks. It is Sunday, April 29. It's almost 10 a.m. on the East Coast of the United States. I've been absent for a while. You know what they say, life is what happens while you're making other plans. And so, anyway, life's been happening. The good news is that I now have more time to spend with the financial markets and with you. And hopefully, together, we can profit from those financial markets, or at least protect our existing wealth as the global debt collapse. Oh, look at that. That's what we're going to talk about in this video is the global debt collapse. And so let's jump right into that. So there are two major factors that I want to talk about. The big point or the big picture that I want to convey to you today is that the collapse has already occurred. And there are two main prongs of that, if we're talking about forks, sovereign debt and commercial real estate. And so the value of sovereign debt has dropped significantly in the last 12 months, 18 months, certainly. And then the value of commercial real estate, same thing, significant drop in value in the last 2 years. Let's just call it 2 years. And then derivatives, that third bullet point, we don't really know. It's such a fuzzy market. It's such a gray area. We don't really know the value of derivatives. Some people put it at 2 quadrillion. I can't even put my mouth around that one. 2 quadrillion, maybe 3 quadrillion in value. And a lot of those derivatives were written based on current levels of interest rates. And obviously, interest rates have changed significantly. And so something has happened to the values of these derivatives. We just don't know what that is. But again, it goes into the point of the collapse has already occurred. We just don't have the details of the collapse yet. And so as we're thinking about sovereign debt in particular, let's keep in mind, again, painting the big picture, this went on for several years where they were selling long-term debt at near zero rates, or even in some cases, negative interest rates, which, how that makes sense. The only way that makes sense is when you are investing other people's money. You're a sovereign wealth fund, you're a pension fund, retirement fund, etc. You're investing other people's money, and so somehow you rationalize investing at negative interest rates. Because clearly no rational person would do that with their own money. But and so anyway, long term. 50-year bonds, that's the longest duration that I'm aware of, that, in this multi-year period where they were selling this debt, the longest duration, I believe this was in Europe, was 50-year bonds. And so this is the kind of stuff that's sitting out there when retirement funds, pension funds, hedge funds, sovereign wealth funds, any kind of institutional investor, insurance companies, any kind of institutional investor you want to talk about, this is the kind of stuff they're holding. It's basically, I'm hesitant to call it garbage, but if you and I were investing our new money today, we'd look at this and we'd say, oh, well, that's garbage. I'm not interested in that. But anyway, let's keep rolling. So again, the collapse has already occurred. We haven't done the paperwork yet. As is typical of, just look at history, the collapse is only going to be revealed a little bit at a time over a period of several years. And so, we'll see this company will collapse, that company will collapse, there'll be takeovers and mergers, etc. As much as possible will be swept under the rugs by the Federal Reserve and the Treasury and, the central banks, that they'll try to hide as much of this or obscure, obfuscate. as much of the collapse as is possible. But again, the collapse has already occurred. So this next thought, and actually it's these two thoughts together. So this debt collapse, basically this is the end of the fiat currency, the debt-based fiat currency system. We're in the end phase. This is the end game stage. And the collapse of the value of that debt, and obviously, folks, I'm just voicing my own opinion here, that sets up the need for a global reset. Obviously, you've played your fiat game. I'm speaking from the perspective of central bankers. You've played your fiat game and it's worked well for you. In this case, it started in 1913. Here we are, it's 2023. So 110 years. I mean, you've had a 110-year run. That's pretty darn good. In my opinion, 110-year run as business, that's a good run. But so anyway, your business model of basically selling debt-based currency to the world is at its end phase. What do? Well, you need a reset. You need some way of washing away 110 years of debasing the currency. You need to wash all that away and start over from scratch. It's the global reset of the monetary system. And so in past cycles, based on my study of financial history, economic history, the way that the central bankers would accomplish the reset was World War and then pandemics. And, sometimes they go together. Sometimes they follow one another. Most recent was, World War followed by pandemics. Certainly that was World War One. We had the war happening, and then pandemics wiped out millions of people. And so in the current cycle, it's been more of a reverse of that, is that we got to start with the pandemics, and we're trying to and when I use the word we, I don't want to imply that it's the common human beings living on planet Earth. We're whirling through space at 17,000 miles an hour. We're not interested in going to war with anybody. Don't care. Not interested in going to war. So when I say we, I'm referring to the globalists, the neocons, the people who profit from the endless cycle of war that's played here on planet Earth. But so anyway, in the current cycle, it looks like we've started with the pandemics and we're trying to move into World War. If you are interested in history and economics, both, I strongly recommend this book, Creature from Jekyll Island, G. Edward Griffin. He takes a close look at the history of the Federal Reserve, and don't be intimidated. It's a thick book, so if you see it in paperback, it's literally it's at least 3 inches thick. It's a big book and it's intimidating to look at, but Edward provides a quick read guide where basically you can digest the gist of that book in 2 days of reading. Certainly 2 days of reading, you can digest the bulk of the meaning of that book. But one of the major points that he makes in the book is that the central banks finance the major wars, the world wars, and they finance both sides. It's just part of their business model. They profit from war same way that the military-industrial complex does. But anyway, I'm rambling. Let's keep rolling. So now we're looking at let's dive down a level and focus at each of the prongs of the global debt collapse. And so in this case, we're looking at the collapse of sovereign debt, the value of sovereign debt. And again, the collapse has already occurred. It's just not visible. So we got a peek under the covers, if you will, when Silicon Valley, that's Valley, not value, typo there. I guess that's kind of a tongue-in-cheek Freudian slip, because obviously the value wasn't there or they wouldn't have collapsed. But anyway, Silicon Valley Bank, they needed to raise liquidity, and so they went to sell some of their assets that they were holding on their books. And what they had to do was face up to reality. The stuff that they were holding on their books, treasury debt, wasn't worth what they were claiming it was worth. And, whether it was 30%, 40% haircut, we don't know exactly what the level was, but it was a significant haircut when they went to sell those assets. And then, my understanding is that the word of those sales and the haircut got out, and that started a run on the bank, and that ultimately, SVB collapsed. But that's just one example of how the collapse already occurred. The value of the assets that this institutional investor, SVB in this case, the value of their assets had already collapsed. They were only forced to face or acknowledge the collapse when they had to sell some of their assets. And then they take the haircut, and bad things happen. So this condition, the condition that affected SVB, well, that's the same boat that all these other institutional investors are in currently. Banks, credit unions, insurance companies. I hadn't thought about that one until just recently. Insurance companies, they're certainly an institutional investor. They've got treasury securities, mortgage-backed securities, and then, of course, pension funds, hedge funds, etc. And so this same collapse has already affected all of these institutional investors. We just haven't seen it yet. They haven't been forced to acknowledge, they haven't had to swim naked yet. For any number of reasons. SVB had to swim naked, and and it didn't go well for them. And of course this goes right along with this situation, is that these institutional investors are allowed to use historical cost accounting, which means on their books they're allowed to hold these assets. I'm using air quotes around assets. They're allowed to hold these assets at their acquisition cost. Just basically, I paid $1,000 for it. It's worth $1,000 forever. Even when it's only worth $600, it's still, as far as I'm concerned, on my books, it's worth $1,000. And of course, the alternative to historical cost accounting is mark-to-market. And mark-to-market, that's what happened with SVB. They were forced to mark their assets to market. They took a 30 or 40% haircut, and then bad things ensued. So let's take a look at, based on the charts, because, as always, I'm a visual thinker. I like looking at the charts. What does this collapse look like currently? And so we'll focus first on the sovereign debt. And so we're going to look at a number of ETFs that invest in sovereign debt. Here is, this is TLH, iShares 10 to 20 years. This is investment grade U.S. debt in this ETF. They've experienced currently about a 36% loss. It waffles around there. Is it more than that? Is it less than that? But anyway, in general, 36% loss. And so again, if they were, for whatever reason, if this ETF were forced to liquidate, if investors decided, hey, just give me my money back, I want out, they would have to acknowledge this 36% loss when they went to sell the bonds, the debt instruments that they are holding as an institution. So another one here, 42% loss. Again, the loss has already occurred. Vanguard bonds, sovereign debt again. This ETF in particular, investment grade, no tips, no municipals, 21% loss. That was high to low. It's probably, currently it's 15, 16%. Here's another insight, and so we're looking at the idea, or the main theme of this video is that the global debt collapse has already occurred. We're just getting a slow motion look at the collapse as it is acknowledged in the financial markets. And so here is one of the latest banks to suffer from this collapse, First Republic. Obviously, this is a monthly time frame that we're looking at. Can you imagine? So this was in November of 21. This thing traded at a high of $223, and on Friday this pig closed at $3.51. So, you're up here and you're eating caviar and sipping champagne, and down here you're wondering, which of your expensive cars you sell first to make next month's mortgage payment. But anyway, rags to riches, as they say. So, all right, let's look now at commercial real estate. And again, this is a significant asset category, forms a part of the foundation, or a major part of the foundation of the financial world in both the United States and the rest of the world. And the value of that real estate has collapsed. And, there's a couple of factors that have contributed to that. The health issues of recent years demonstrated to workers that they could work from home and that they preferred to work from home. And so now employers are having challenges bringing workers back into the office space. Offices are sitting vacant. There's lots of office space, both for rent and for sale. And of course, both of those factors depress the value of office space. Interesting factor to keep in mind as we're considering the value of commercial real estate. So we've got about $2.9 trillion worth of debt outstanding on commercial real estate. I think that's in U.S. I need to do some due diligence and see if that's U.S. or global. I'm betting that that's U.S. Half of that debt is due in the next few years, and I think it's 5 years. We'll look at a chart here in a moment and see some more details on this. But anyway, a significant portion of this debt on commercial real estate needs to be rolled over in the next few years. Rolled over meaning it's coming due. It either has to be paid off or rolled into new debt instruments, and so that becomes an issue when the value of the assets, the commercial real estate, has dropped significantly. So this just kind of, again, painting the big picture. The multi-year environment of low or zero interest rates caused institutional investors to reach for yield. When you buy a treasury note or a treasury bill, bond, whatever, and it's paying less than 1% interest, well, clearly you need to leverage that up somehow, because when you're on the one hand, you're telling your investors, and I'm speaking as I'm a pension fund, I'm a retirement fund, whatever, I'm telling my investors that I'm going to get a 7 to 8% return on your money. But now I'm turning around and I'm buying U.S. Treasury debt at 1%. Well, how do I get a 7 or 8% return out of a 1% instrument? The only way I can do that is by using leverage. And so, margin, debt, however you want to look at it, institutional investors were reaching for yield, which meant they were adding leverage on these low yielding bonds. And so, whether you want to talk about commercial real estate or sovereign debt, they were using margin to try to get their 7 to 8% returns. So, and so the institutional investors, they're trying to invest in investments that only make sense in an environment of cheap money, 0% interest rates, and the ability to apply high leverage, again, easy money. And so what those investments looked like, it was commercial real estate, high yielding securities, stocks, Chinese real estate, etc. It's all high risk stuff. And in particular, for our current analysis, all of those investments will be negatively affected by high interest rates. And of course, that's the environment that I believe we are in. It's a sustained environment, multi-year environment of higher interest rates and increasing interest rates. And so now we've got a couple of charts here that we're going to focus on commercial real estate. This is iShares real estate ETF. Currently about a 26% loss from the peak. And again, the reason I'm showing these ETF charts is we're looking for insight into what are these institutional investors holding. And so they may not have invested in IWR. More likely, they have invested directly in the bonds of individual real estate investments. And so anyway, they may or may not be invested in IWR specifically, but this gives us some insight into what they are experiencing on their book, the holding, the assets that they are holding on their books. And so just guessing, we would assume that they've lost 26% in the last 2 years, whatever that is, less than 2 years. They've lost 26%. And then for me, it's logical to me, my warped brain, okay, they're currently down 26%. How did they fare in the past? And in particular, the 2008, how'd they do at that point? Well, this particular ETF experienced a 72% loss. Well, if they can lose 72% in 2008, who says they can't lose 72% in 2023? And so anyway, that's kind of a red flag for me anyway. Here's another, what do we got here? This is a ETF, mortgage-backed securities. And so this is another way that institutional investors have deployed their money, their investors' money, is into mortgage-backed securities. And so we're looking for some insight into how have those, that's mislabeled. That should be real estate debt, not sovereign debt. So we're looking for insight into how has this mortgage-backed debt fared in the markets. And so we can see, currently down, 18% from March of 2020. So, the last 3 years, 21% from the peak. Let's see, investment grade U.S. bonds, 7-year maturity. So Again, mortgage-backed securities, investment grade, U.S. commercial mortgage-backed bonds. So currently down 16%. Overall down, 20, 21% from the peak. This is commercial real estate. Another factor when we're looking at commercial real estate is that there is currently a wealth of vacant office space available. And, whether you're talking about residential or commercial real estate, all real estate markets are local. Meaning, the real estate market in San Francisco is not the same real estate market in Tampa, Florida, or, Virginia, whatever. All real estate markets are local. And so we have to be careful when we start using national metrics against local real estate markets. But in general, there is a wealth of vacant office space, whether you want to talk about for lease or for sale. And obviously this article is talking about all-time high in available office space for rent. What else have we got? I'm wrapping up here. So this is a Barbra Streisand song, You Don't Bring Me Flowers Anymore. And the line, as I was preparing these charts and thinking about, it's like, okay, what do I want to share with you guys today? This song, for whatever reason, came to mind. And again, the collapse has already occurred. We just have to acknowledge the collapse and deal with the accounting. Exactly who's going to lose money. You're going to lose 70%. You're going to lose 100%. We have to do that accounting, but the collapse has already occurred. And so this line, that's what popped into my brain, is that they just lay on the floor until we sweep them away. And so all of this, the sovereign debt instruments, mortgage-backed securities based on commercial real estate, derivative debt based on interest rates and real estate, all of that stuff, the collapse has already occurred. We're just in the process of sweeping them away. And so anyway, that's all I got to share with you in this video, folks. I'll do a market overview. It's been a while. Not all that much has happened, but anyway, talk to you soon.